And Eddie Ghabour, co-owner at the Key Advisors Group. Eddie, what's your read on the market right now, what it's reacting to, in particular this week?
You know, this market, we've just gone through a pretty vicious bear market bounce, and then the Fed poured cold water on the narrative of them being dovish or cutting rates anytime soon. So I think the market is really going to go into become very volatile here into the fall, because the bottom line is, and Mr. Powell just reiterated it this morning, they're going to continue to raise rates and tighten until they get inflation down to a level that they feel comfortable with. The problem with that is they're using rear view mirror data, in my opinion, and by the time the data supports what they're trying to do, there'll be too much damage done to growth and the economy. And this is why we firmly believe, in our opinion, that the market will hit lower lows before it hits new highs. So I would be very cautious here as an investor, because the other thing is the quantitative tightening they're doing and the amount of bonds they're going to have roll off their balance sheet over the coming months has never been tried before. This is the fastest tightening we have ever gone through, and we believe we are heading into a global recession. That's how we're positioned for clients, and we're, again, in uncharted territory right now with what they're trying to do.
Speaking of that backwards data, perhaps when it comes to inflation, next week we're going to get CPI data that is a lagging indicator. Do you see enough evidence in the economy that inflation is trending downward? And if we get a CPI read that does show another cooler print that we saw kind of in relation to the last one, do you think that's enough evidence for the Fed that it should start to maybe ease up on some of these rate hikes?
Well, I believe they've already tightened too much too fast. So they're looking at it through a different lens than we are. We're trying to look at forward-looking expectations. And I think forward-looking expectations over the next 6 months to 12 months is growth is going to be slowing materially, and that means inflation will come down. The problem is you're not going to go from 9% to 3% overnight, no matter what the Fed does, because rents are going to stay high, food prices are going to stay high. So again, a lot of the data they're looking at is rear view mirror data, and they're so focused on the labor market. And I want to stress this. Again, our opinion is the labor market is the last thing to fall apart when you're in a recession. So by the time you get the labor market extremely cooled off, in our opinion, it's too late. So I think they've over-tightened already. My personal opinion is if they would just let the markets do what it does, it would take care of itself.
What do you think then is a better indicator to look at? We know the Fed prefers PCE. Often, we talk about, CPI, but those are all lagging indicators. What's a better indicator, you think, for the Fed to look at? And then what are those indicators saying?
So look, I think if you just listen to what corporate America is telling us, just on these earnings reports, they're really kind of pounding the table. Like, look at the retail sector, for example, right? They're talking about the consumer behavior changes and what they're spending. Inventories are rising. We are seeing job cuts. They're not at a big pace, but they always start off small before they accelerate. And then again, just looking at the growth, the economy is slowing materially. And I think they need to understand, well, they do understand this, that it takes time for these rate cuts to actually filter into the system. They've said that themselves. The problem is they're not giving it time to do its job. So they're going to tighten. And again, they're going to be put in a position where there's nowhere to go but down, unfortunately, economically. And this is why now, especially after what they've reiterated this morning, it just reconfirms our stance that we are going to have a hard landing in this market. It's not going to be a soft landing.
Speaking of that, and speaking of earnings, which you're saying are kind of a better indicator maybe for the Fed to look at and kind of read through what the markets more broadly through quarterly results are saying, one of the things that we've seen is excess inventory, especially in the retail sector, right? Could huge discounts, bode well or better for consumers in the holiday shopping season? And has inflation, to your point there on what we're seeing in earnings, deterred spending enough that we do result in that hard landing? Because if you got spending pulling back, then you got the Fed trying to tamp down on demand even further, you don't execute a soft landing for sure.
Yeah, and that's what's happening now. I mean, the bond market's indicating that. And the other thing, too, to piggyback off of that is now housing. Housing touches a huge part of our economy. And now there are some big cracks in housing. We've seen some material slowdowns there. We're seeing listings continue to increase in regards to inventory, prices coming down. They've done their job of causing demand destruction. And I would argue that if they didn't do another thing right now, that we would still go into a recession, but it would be more shallow and maybe softer. But again, the writing is on the wall. The consumer is in a very tough spot right now, and it's going to take a while for this to reverse itself. Again, this is why I think investors need to be very cautious, because these inventory levels are so high. That means prices are going to have to come down. That means profits are going to get crushed. So these companies, we expect them to revise earnings in the coming weeks as we go into third quarter earnings and then heading in the fourth quarter. So we got a rough few months ahead of us.
In terms of potential opportunity, right? Because I don't want to seem like an all Debbie Downer, and there's always a contrarian view to the market, or at least a view of what sectors, could benefit. Which areas, perhaps of consumer staples, do you think are going to climb in the next few months?
So right now, in our tactical strategy, the only two sectors that we own are utilities and staples. We feel like those weather the storm better. Utilities have had a great year for our clients. But I do think with this Fed over-tightening, causing the market to hit a lower low is going to be a great opportunity. We've told our clients we plan to start buying into the sectors that have gotten beaten up the most, and going into the fourth quarter of this year at some point in time, as well as the first quarter of next year. Because I do think this market will bottom well before the economy bottoms, because it's a forward-looking indicator. So these next 6 months could present some really good buying opportunities for your higher risk assets that could be down anywhere from 30 to 45%.
Let's talk energy for a minute, right? Because a lot of activity happening there, has happened over the past year or so now. But even right now, new Prime Minister Liz Truss over in the UK is announcing a cap on energy bills to combat the cost of living crisis that they're dealing with there. This, of course, comes as Putin then threatens to cut off oil and gas exports. How do you see the energy markets moving? There's so many components there. What's your broad outlook on oil and gas industry in the next couple of months?
So look, we have a supply issue in the oil and gas sector, and there's no doubt there is an energy crisis overseas. And my heart goes out to those folks, because a lot of those families are not going to be, even with these caps that they're going to put on energy prices and utility bills, it's already at a level that's unsustainable. And so they're absolutely, in our opinion, going to see a harder hit economically to the consumer because of the energy crisis that they're in. And so I think what you're seeing right now is a function of the futures markets seeing the demand destruction, which is why oil has come down as much as it has. I would expect here in the near term to see a bump in these energy prices again, because one dynamic we have is normally in a recession with demand destruction, you would see these sectors really plummet. But we have a supply dynamic in the issues in Russia that we haven't had to deal with during this type of recessionary environment. So I think it's going to be very range bound. I expect it to go up here in the near term because it's probably oversold. And that's going to continue to keep inflation sticky. No matter what the Fed does with rates, inflation is going to stay sticky for the near term.
When I look at your kind of broader outlook, the macroeconomic environment that you've painted so far, we're talking about a hard landing here in the U.S., even more challenging times abroad. I imagine then your thesis is that we're looking at a potential global recession. And if so, what exactly does that look like? How persistent of a recession are we potentially talking about?
Yes, so we do believe we're going to have a global recession. And look, at the end of the day, when we look back at the bubble that formed with doing a lot of loose monetary policy, sending out checks to everyone, if those things cause asset bubbles to happen, when the governments do the opposite of that, it causes bubbles to burst. And in our opinion, that's what's happening right now. Now, those that have cash or have been defensive throughout this bubble bursting are going to have some of the best opportunities that they've seen in a while. But the cycle has started. The tightening cycle is happening globally. And this is why we think we're going to have a global recession. And the market, in our opinion, is going to have a hard landing because the Fed and the global economy is just going to continue to tighten into this economic slowdown. And you'd be hard-pressed to ever find a time in history when you're tightening monetary policy during a slowdown where markets don't have these type of environment that we're faced with right now. So again, we can't stop this cycle that's already started. The demand destruction is underway. And again, I think the next 6 months are going to present some great opportunities for investors, but the economy is going to take a lot longer than 6 months to get back on its feet.
Eddie, always good to have you on. Great insight. Eddie Ghabour, owner at the Key Advisors Group.